Hi, I'm Gloria Ledoux. I'm the CU Compliance Connection by League Info site, here to bring you the compliance outlook for a review of the first quarter of 2017 and a sneak peek at the second quarter. We'll start off our review of the first quarter by taking a look at the NCUA rules that became effective, including the new member business lending rules, changes to the fixed assets rule impacting our federal credit unions, and changes to the chartering and field of membership manual, which also impacts our federal credit unions. The CFPB had some action for us too. A small piece of the HMDA rules, or the Home Mortgage Disclosure Act, became effective at the beginning of the year. And of course, we have all of the annual updates that are tied to our various consumer price indices, which we can't just blame on the CFPB because some of the changes were driven by the FRB, the Federal Reserve Board, and the IRS. Finishing up the first quarter, we have the FFIEC, or the Federal Financial Institutions Examination Council's revisions to the Uniform Interagency Consumer Compliance Rating System that becomes effective at the tail end of March. Although there is no new regulatory requirements imposed as part of the revised rating system, it is important for credit unions to understand what the examiners will be looking for related to consumer compliance. For the second quarter, we may have an effective date of the Department of Labor's changes to the fiduciary rule. The rule was initially supposed to become effective on April 10, 2017. However, a proposed rule was issued that would delay the effective date by 60 days. That proposal hasn't yet been finalized, so credit unions should probably prepare for that June 9, 2017 effective date until we receive confirmation in the final rule. But there is a chance it may be delayed even longer than that 60 days. All right, let's dig into the changes that became effective the first quarter of 2017. Hopefully, credit unions have already made their revisions to policies and procedures regarding the new NCUA member business lending rules. There were some pretty significant changes to the rules, some of which were actually beneficial to credit unions, including the elimination of restrictive requirements for loan-to-value ratios, obligor limits, and construction and development loan limits. One of the main changes was the addition of the commercial loan definition. This definition was added in order to distinguish between the commercial lending activities in which a credit union may engage, subject to the safety and soundness provisions of the rule, and the statutorily defined member business loans that are subject to the aggregate cap. The NCUA published a summary of key changes to the final rule, which included this comparison chart. The chart is extremely helpful in wrapping your head around the changes in the definitions and allows credit unions to more easily distinguish between those loans that are MBLs, the member business loans, or commercial loans under the new rules. A commercial loan is defined as any loan, line of credit, letter of credit, and any interest a credit union obtains in such loans made by another lender to individuals, sole proprietorships, partnerships, corporations, or other business enterprises for commercial, industrial, agricultural, or professional purposes, but not for personal expenditures. There are some loans that are actually excluded from the commercial loan definition, such as loans secured by a vehicle manufactured for household use or a loan fully secured by a 1 to 4 family residential property, regardless of the aggregate net member business loan balance exceeds $50,000. The definition of a member business loan includes a commercial loan, except for 2 loan types. The first is a non-member loan or participation interest in a commercial loan made by another lender, provided the credit union acquired the loan or interest in compliance with all relevant laws and regulations. And the second is any loan in which a federal or state agency fully ensures repayment, fully guarantees repayment, or provides an advance commitment to purchase the loan in full. As part of the new rules, credit unions should now have a formal process in place to assign credit risk ratings to commercial loans at inception and review them as frequently as necessary to satisfy the credit union's risk monitoring and reporting policies and to ensure adequate reserves. The score must be determined through an evaluation of financial performance and qualitative factors based on management, operational, market, and business environmental factors. The previous loan-to-value limit of 80% was removed from the new rule. Credit unions now need to ensure they have collateral sufficient to provide adequate loan balance protection, along with appropriate risk sharing with the borrower and principals. For unsecured loans, there must be sufficient documentation on file, with the mitigating factors that sufficiently offset the relevant risk. In the NCUA Examiner's Guide, there is guidance for the examiners outlining appropriate industry methods for valuing collateral and establishing appropriate maximum LTVs for various collateral types. This slide contains the accepted industry standards for LTVs for real estate that were included in the guide for credit unions' reference. While the existing provision remains of limiting the credit union's commercial lending to one borrower or group of associated borrowers to the greater of 15% of the credit union's net worth or $100,000, the credit union now has the ability to exceed that limit up to 10% of the credit union's net worth. The ability to exceed that limit is contingent upon the amount exceeding that 15% being fully secured with a perfected security interest in readily marketable collateral. The new rules include a definition for readily marketable collateral. This definition is comparable to existing bank regulations, which is defined as financial instruments that must be saleable under ordinary circumstances with reasonable promptness at a fair market value determined by quotations based on actual transactions on an auction or similarly available daily bid and ask price market. Effective on January 20th were the NCUA's changes to the fixed assets rule. The new rule eliminates the requirement that a federal credit union must plan for and eventually achieve full occupancy of premises they acquire. Instead, the NCUA modified the definition of partially occupy to mean occupation and use on a full-time basis of at least 50% of the premises by the federal credit union, or a combination of the credit union and a QSO in which the credit union has a controlling interest. Federal credit unions now must partially occupy premises that are acquired within a reasonable period, but no later than 6 years after the date of acquisition. The waiver process does still exist for credit unions that may need to exceed this time period. The NCUA also revised their chartering and field of membership manual. Those changes became effective on February 6th of 2017. There were quite a few changes made to the manual, which included changes to the definition of a local community, a rural district, and an underserved area. There were also expansions to the single common bond federal credit union charter and the multiple common bond federal credit union charter. One of the changes made was the inclusion of select employee group contractors in a multiple common bond credit union. Credit unions have the ability to add persons who work regularly for an entity that is under contract to any of the SEG sponsors listed in the credit union's charter, provided that there is a strong dependency relationship between the contractor and the SEG sponsor in each case. The multiple common bond charter may also combine individual occupational groups that each consist of employees of a retailer or other business tenant of an industrial park, shopping mall, office park, or office building. Credit unions with a single common bond based on employment in a trade, industry, or profession can include employment at a number of corporations or other legal entities that have a common bond by virtue of providing similar products, providing similar services, or participating in the same type of business. Ordinarily, third-party vendors or suppliers would not be included. However, now they may be on a case-by-case basis if there is a strong dependency relationship. A strong dependency relationship is defined as a relationship between TIP entities and their vendors and suppliers in which they rely on each other to the extent, for example, that the absence of one would likely cause the other to suffer, a material decline in either revenue, functionality, or productivity, among other consequences. An example indicated in the manual would be a firm whose employees are specially trained to protect nuclear facilities and whose employees work primarily at these facilities. Those employees could be part of a TIP based on the firm's participation in the nuclear energy industry. Also, to recognize the contributions of those who have served in the U.S. Armed Forces and to provide them the benefit of access to credit union service following active duty, the NCUA now permits credit unions to include as an affinity group within its common bond the honorably discharged veterans of any branch of the U.S. Armed Forces listed in its charter. The final rule automatically grants membership eligibility. So we know that there are some really big changes coming up for the Home Mortgage Disclosure Act, or HMDA, most of which become effective in January of 2018. However, there is one aspect of the rule that became effective on January 1st, and that was the revised definition of a financial institution. So, in addition to the previous criteria, such as asset size, which is still $44 million for 2017, having a branch office in a metropolitan statistical area, being federally insured or regulated, the new rules added an additional test for the credit union to meet. Therefore, in addition to the previous requirements, now the credit union must also have, in each of the 2 preceding years, originated at least 25 home purchase loans, including refinancings of home purchase loans that are not otherwise excluded. The excluded data outlined in the regulation includes loans originated or purchased by the credit union acting in a fiduciary capacity, loans on unimproved land, temporary refinancing, the purchase of an interest in a pool of loans, the purchase solely of the right to service loans, or loans acquired as part of a merger or acquisition. So, to put this all together, a credit union that originates at least 25 home purchase loans, including refinances of home purchase loans, in each of the 2 preceding calendar years and meets all the other criteria listed, would be required to report HMDA data for 2017. However, if the credit union originated less than 25 home purchase loans in each of the past 2 calendar years, then it would not be required to report HMDA data, even if it meets all the other reporting criteria. Lastly, if the credit union originated 25 home purchase loans in 1 calendar year and then originated less than 25 in the subsequent calendar year, the credit union still would not be required to report HMDA data for 2017. All right, let's now dive into our annual threshold changes. Remember, credit unions should make sure that their respective policies and procedures and their lending platforms or systems are up to date with these new thresholds that became effective on January 1st of this year. The Home Ownership and Equity Protection Act, or HOEPA, governs high-cost mortgage requirements. If the credit union is originating a mortgage that is considered high cost, they will have to provide specific disclosures. There will be certain restrictions on transaction terms, fees, and practices, and there are specific ability to repay requirements, and the member must have home ownership counseling. As with many of the CFPB's regulations, certain thresholds adjust each year in accordance with the Consumer Price Index for all urban consumers. For HOEPA, the CFPB adjusted the points and fees thresholds to determine if a loan is considered a high-cost mortgage. So credit unions' loans with points and fees exceeding these thresholds will be considered high cost and subject to the additional restrictions. Some credit unions may be eligible for an exemption from the escrow requirements for higher-priced mortgage loans. Each year, the CFPB adjusts the asset threshold. For 2017, it's going to be $2.069 billion. Remember, in order to qualify, the credit union also has to meet the other criteria listed as well. As a reminder, credit unions must maintain and establish escrow accounts for first lien, higher-priced mortgage loans for at least 5 years. This requirement does not apply to subordinate liens or HELOCs. However, if you have a fixed home equity in first position, the escrow requirements will apply if the loan is considered to be a high-priced mortgage loan. For a loan to be considered a qualified mortgage and receive the safe harbor, the loan's points and fees must not exceed certain thresholds. These thresholds typically increase each year. These are the new thresholds for 2017. Again, if credit unions are relying on their lending systems to acknowledge if a loan is considered a higher-priced mortgage loan or a qualified mortgage, it is important to make sure these thresholds are updated in those systems. Credit unions should be aware of the safe harbor penalty fee limits for credit cards. Technically, the $38 fee for subsequent violations was the same in 2016 as it is for this year, although it was corrected at the end of the year in 2016. The safe harbor for the first late payment fee stayed the same as well. As part of Regulation D, credit unions are required to maintain certain reserves based on the mix of deposits at the credit union. The threshold amounts for those reserve requirements adjust each year and are listed here for your reference. The IRS changes the HSA or the Health Savings Account contribution limits each year. For 2017, the limit for an individual plan is $3,400, and the limit for a family plan is $6,750. All right, we're cruising right along. Effective at the end of the first quarter are the FFIEC's revisions to the Uniform Interagency Consumer Compliance Rating System. The original rating system was established in 1980. So these new changes are going to reflect the regulatory, examination, technological, and market changes that have occurred since then, which we all know there have been a lot. This rating system essentially provides a framework for examiners for assessing risks during their examination using certain compliance factors. Credit unions will be assigned an overall consumer compliance rating that will impact the management component of the overall CAMEL rating. The Consumer Compliance Rating System is organized under three categories: Board and Management Oversight, Compliance Program, and Violations of Law and Consumer Harm. The rating system places emphasis and establishes incentives to promote consumer protection by preventing, self-identifying, and addressing compliance issues in a proactive manner. The rating system will recognize credit unions that consistently adopt those compliance strategies. The takeaway for credit unions is to take a look at the revised rating system and the associated definitions. Make sure your credit union has a compliance program in place that really addresses all of these new factors. Does your credit union have a process in place to stay on top of changing regulations? Is proper compliance due diligence conducted in advance of new product launches or product changes? Is your credit union proactively identifying compliance issues and working quickly to fix those issues? Be prepared to discuss these types of questions with your examiner and how this fits into your credit union's compliance management system or program. Okay, moving on to the second quarter. If you have been involved in trying to interpret the Department of Labor's fiduciary rule amendments, you know that there is still some uncertainty regarding certain credit union activities and if they may be considered prohibited transactions under the new rules. Thankfully, we do have some extra time because the Department of Labor issued a proposed rule that delays the effective date and may also leave the door open for some additional amendments to the rule. While we don't have a final rule and therefore a final effective date to talk about in this video, we recommend that credit unions prepare themselves, just in case, for a June 9th effective compliance date. In a nutshell, this rule requires that all financial institutions, including credit unions, and their advisors give advice that is in the best interest of the retirement investor or your member. The advice must meet a professional standard of care, must be based on the interest of the customer or member, and charges can be no more than reasonable compensation, and there can be no misleading statements about investment transactions, compensation, and conflicts of interest. In order to comply with the rule, credit unions need to look at the advice they are providing to their members regarding IRAs, such as rollover options and referrals even to third-party broker-dealers. The credit union shall look at this advice and their corresponding compensation structure in order to avoid prohibited transactions, or they may have to use an exemption such as the best interest contract exemption. Generally, a credit union can provide referrals to affiliates or CUSOs who are providers of retail non-deposit investment products, and that is not considered a fiduciary investment advice giving rise to a prohibited transaction for which an exemption is required. But again, it's important to conduct an appropriate analysis based on what your staff communicates with the member and how they are compensated for any referrals, if at all. So what would constitute a fiduciary investment advice? A recommendation with respect to rollovers, transfers, or distributions from a plan or IRA, including whether or not to even conduct the transaction, in what amount, in what form, and to what destination, such as a rollover, transfer, or distribution should be made. There must also be a fee or other compensation for a communication to be investment advice under the rule, in connection with or as a result of the recommended transaction or service, including revenue sharing payments. So keep in mind, if the credit union provides a member with options in their marketing materials in person, on the phone, such as options to leave assets in a plan, cash out, or roll over to a new plan or IRA, then refers that plan participant to a recommended third party who provides the investment advice, and then the employee receives a referral fee from that third party, that would be considered investment advice, and the receipt of that fee would be a prohibited transaction unless the credit union complied with the applicable exemption. The Department of Labor put together some helpful, frequently asked questions, and there's 2 sets of them that credit unions should reference when reviewing their procedures and their processes associated with communications about retirement accounts and referrals to third-party broker-dealers or QSOs. Wow. That was a lot. So as always, I really thank you for joining me at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union. We are here to help you at the CU Compliance Connection by League Info site.